Right now, five central banks that combined hold more than $2 trillion in reserves are quietly moving out of US dollars. Not because they want to, but because they've run the scenario. They know exactly what happens if they're still holding dollars when everyone else decides to leave. The question isn't whether the dollar loses its reserve status. The question is, what does the first 72 hours actually look like? Because nobody's modeling that for you. The official position from the IMF, from the Federal Reserve, from most Western economists, is that the dollar is irreplaceable. And in a narrow transactional sense, they're right. The dollar still dominates 89% of all FX trading. But what that framing misses is this. Reserve status and transactional dominance are two different things. Reserves are where you store value. Transactions are where you move it. And right now, the world is quietly, methodically, moving stored value out of dollars, while still using dollars to pay for things. That divergence cannot hold indefinitely. When it breaks fast. If this kind of analysis is useful to you, subscribe. We publish new scenarios and data breakdowns every week. The dollar became the world's reserve currency, not because of American economic virtue, but because of a deal. In July 1944, with Europe in rubble and the US holding 2/3 of the world's gold, 44 nations gathered at Bretton Woods, New Hampshire. They agreed to peg their currencies to the dollar, which would be pegged to gold at $35 per ounce. The US got an extraordinary privilege, the ability to print the world's money. Every other country had to earn dollars by exporting real goods. America could simply create them. That arrangement officially ended on August 15, 1971. Nixon told the world, with no warning on a Sunday night, that the US was closing the gold window. Dollars were no longer convertible. The anchor was gone. What replaced it wasn't another commodity. It was trust, and a second deal, the petrodollar agreement with Saudi Arabia in 1974. Oil, the commodity every industrial economy depends on, would be priced and sold exclusively in dollars. If you wanted oil, you needed dollars. If you needed dollars, you needed to hold them, buy them, lend them. Reserve currency status was secured not by gold, but by barrels. That second deal is now under systematic pressure. Saudi Arabia is conducting oil trades with China in yuan. Russia and Iran conduct over 95% of bilateral trade in rubles and reals. China's alternative to SWIFT, the CIPS payment system, processed $26.4 trillion in yuan transactions in 2025 alone. The infrastructure for a non-dollar energy market has been quietly built over the past decade. The question is not whether it exists, it does. The question is what happens the day a critical mass of actors decides to use it all at once. What makes this moment different from previous dollar decline discussions is the convergence of three factors that have never previously overlapped. The US is running trillion-dollar annual current account deficits. Its debt interest payments now exceed its defense budget. And the geopolitical coalitions capable of absorbing a dollar exit, BRICS Plus, now represent 45% of the world's population. Previous discussions of dollar decline assumed no credible alternative. That assumption no longer holds. The data in 2026 shows a split picture that is the hallmark of a system under transition stress. On one hand, the dollar's transactional dominance is actually increasing. 89.2% of FX transactions in 2025, up from 88.4% in 2022. On the other hand, its share of global reserves has dropped from 72% in 2001 to approximately 56% today. These two trends are not contradictory. They are the classic signature of a confidence erosion in progress. People still use the thing, but they're quietly getting their savings out. Central banks are voting with their balance sheets. They bought over 1,000 tons of gold in 2024 for the third consecutive year. Poland bought 90 tons. Turkey bought 75. India's purchases have accelerated. Gold at $3,800 to $4,000 per ounce in 2026 is not a speculative bubble. It is the world's central banks buying insurance against the scenario this video models. The BRICS Plus architecture is advancing in parallel. The M-Bridge platform processed $55 billion in transactions in 2025, with 95% settled in digital yuan. These are not theoretical alternatives. They are live, tested, and scaling. The US responded by threatening 100% tariffs on any nation using these systems to replace dollar trade. That threat has held India in line. New Delhi signed a bilateral deal with Washington in February 2026, agreeing to halt Russian oil purchases in yuan in exchange for tariff relief. But coercion-based dollar loyalty is strategically fragile. It holds until the cost of compliance exceeds the cost of defection. What the system currently lacks is a trigger. Every component of a dollar confidence crisis exists. The infrastructure for alternatives, the erosion of reserve holdings, the geopolitical motivation, and the fiscal vulnerabilities. What is missing is the event that makes simultaneous exit the rational choice for a critical mass of actors. History suggests it will come from somewhere unexpected. Hour zero. A major trigger event. For the scenario, assume a G7-level central bank announces it has reduced its treasury holdings by 20% and is formally diversifying into a basket of yuan, gold, and euros. It's 6 a.m. London time. FX markets open. The dollar index drops 4% in the first 20 minutes. That is a decade's worth of volatility, compressed into minutes. Circuit breakers don't exist for currency markets the way they do for equities. Trading continues. By hour 6, the drop is 7 to 8%. Dollar-denominated commodity contracts begin triggering margin calls globally. Hours 12 to 24. U.S. equity markets open with a gap down of 8 to 12%. The Federal Reserve convenes an emergency session. Interest rate decisions take hours to implement. The damage is happening in minutes. Treasury yields spike as foreign holders consider selling. But here's the counterintuitive dynamic most people miss. In the very short term, a dollar confidence crisis can cause the dollar to strengthen, not weaken. Why? Because trillions of dollars of international debt, loans made in dollars to non-dollar countries, suddenly become more expensive to service. Everyone needs dollars to repay those loans simultaneously. This is the dollar short squeeze, the last gasp of dollar dominance, and the most dangerous phase for emerging market economies. Hours 24 to 72. This is where the mainstream financial commentary consistently goes silent. 12 countries import more than 70% of their food staples, wheat, rice, cooking oil, paid for in dollars through dollar-denominated letters of credit. When dollar liquidity ceases, those payment mechanisms freeze before a single ship changes course. Food price inflation in import-dependent economies can move 30 to 40% in a week before physical shortages begin. Dollar-denominated sovereign debt in the developing world, collectively over $4 trillion, begins repricing. Countries that were managing debt servicing at 5% interest find their obligations recalculated at rates that make repayment mathematically impossible. The IMF's emergency lines are overwhelmed within 48 hours. For the ordinary person in a Western economy, the person watching this video, the first signs are not dramatic. ATM withdrawal limits appear, framed as temporary precautionary measures. Import-heavy product categories begin repricing upward within days. And the psychological shock, the realization that the unit of account for every price, every salary, every savings account is in flux, is itself economically destructive. Every financial decision becomes harder to make. That uncertainty alone costs real money. If this analysis changed how you see the situation, hit like. It helps other people find this kind of independent coverage. The dollar hasn't died. Not yet. Its share of reserves has been declining for 2 decades, and the dollar is still standing. But the reason this scenario matters, and the reason central banks are buying gold at record levels, is that the world is no longer certain it can't happen. And the distance between unlikely and unthinkable is exactly where the most dangerous financial decisions get made. What do you think the trigger actually is?